If you're looking at the price tickers in New York at this very moment, you're likely feeling triumphant. You see silver trading at $70.47 with upward trending charts and the undeniable sense of witnessing history unfold. You probably believe you're observing the absolute forefront of the financial markets. However, you'd be mistaken. What you're actually seeing is the past. To truly grasp the future, to understand the genuine trajectory of silver's price, you must shift your focus away from New York. Your attention needs to be directed towards Shanghai. As we speak, the Shanghai Gold Exchange is facilitating transactions of physical silver at a price that translates to approximately $75.20. This represents a premium of nearly $5 compared to the price in the United States. Do you comprehend the implications of this disparity? It signifies that we are currently existing within a divided global economy. In Western markets, financial institutions are actively striving to suppress prices, keeping them near $70. Conversely, in the East, the industrial sector has already come to terms with and accepted a price of $75. This divergence, this $5 differential, is perhaps the most precarious metric in the financial world. It functions as a powerful draw, a temporal anomaly, pulling precious metals from their historical context in New York and propelling them into the future realm of Shanghai. Until these two price points converge, until the New York market reflects the valuation seen in Shanghai, the reserves held in Western depositories will continue to diminish until they are depleted. Within this in-depth market analysis, we intend to unveil the workings of the Shanghai Arbitrage. We will elucidate why the immediate price you observe on your device is a backward-looking indicator. Furthermore, we will demonstrate why the breakthrough to $70 is not the culmination of a market event, but rather an attempt by the market to realign itself with actual conditions. The West is beginning to awaken, but the East is already well into its day, actively acquiring all available silver. Let's begin by examining the underlying financial mechanics. In a truly efficient and interconnected global marketplace, the value of an ounce of silver ought to be consistent across New York, London, and Shanghai. Any discrepancies present an opportunity for traders to profit. This practice is known as arbitrage. If silver is priced at $70 in New York and $75 in China, a trader would purchase silver in New York, arrange for its transport, fly it to Shanghai, and then sell it for $75, thereby securing a risk-free profit of $5. This transactional activity, buying in the less expensive market and selling in the more costly one, should theoretically lead to price convergence. The act of purchasing in New York would tend to elevate prices, while selling in Shanghai would exert downward pressure. This equilibrium would then be re-established. However, this is precisely what is not occurring. The price differential is actually widening. The underlying reason for this is the overwhelming and insatiable demand within China, so potent that even with the continuous influx of silver, prices persist in their upward climb. Arbitrageurs are incapable of transporting the physical metal quickly enough to alleviate the pressure on the Shanghai market. This observation strongly indicates that the current scarcity is not merely a paper phenomenon, but a tangible physical reality. The Chinese solar panel manufacturers and battery production facilities, which we have previously discussed, are actively driving up prices due to their immediate need for this crucial material. They are establishing a baseline price, and the New York market is being compelled, albeit reluctantly, to follow suit. This situation leads to a crucial realization for any investor. The prevailing spot price in New York is fundamentally flawed. For the past 40 years, the prevailing assumption has been that New York dictates the price of silver. This perception was largely due to the sheer volume of transactions occurring there. However, New York predominantly deals with paper-based instruments such as derivatives, futures, and options. Shanghai, in contrast, focuses on the trading of physical commodities, including actual metal, bars, and immediate delivery. In periods of market surplus, paper instruments tend to set the price. Conversely, in times of deficit, the physical commodity itself becomes the price determinant. We are presently experiencing a deficit market. Therefore, Shanghai now holds the controlling influence. Consequently, when you observe the price of $70.47, do not interpret it as silver's intrinsic value. Instead, consider it the heavily discounted offer from a financially distressed marketplace. The New York market is presenting silver at a substantial discount relative to the rest of the world. Because of this discount, inventory is rapidly depleting. Savvy investors are utilizing the New York market as an inexpensive source of supply. They arrange for delivery in New York at the $70 price, then immediately reevaluate the bars at the prevailing global price of $75. In essence, New York is subsidizing the rest of the world's consumption, and its capacity to offer these subsidies is rapidly dwindling. This arbitrage mechanism is generating a significant outflow, creating a vacuum that is systematically emptying Western vaults. We meticulously monitor the inventory levels at both the LBMA and the COMEX. Each week, these figures show a decline. The underlying reason for this is the persistent price disparity. Why would a mining operation in Mexico choose to sell to a bank in New York for $70 when it could transport its concentrate to a smelter in China that offers $74? The movement of physical commodities invariably follows the path of financial gain. The financial opportunities are concentrated in the East. This implies that Western exchanges are being systematically starved of new supply. They are becoming reliant on existing inventory, the old bars stored in vaults, to fulfill delivery obligations. However, this legacy inventory is finite. Once it is exhausted, the New York market will face a critical decision: either increase its prices to match Shanghai, thereby attracting new metal, or default on its obligations. They are currently opting for the former. This is precisely why the $70 mark was breached today. It was not a consequence of chart patterns or Federal Reserve policy. It was a necessary adjustment to halt the ongoing depletion of reserves. The objective is to narrow the price gap. However, with each price increase initiated in New York, Shanghai raises its own price even further. This dynamic constitutes a chase, and the West is demonstrably falling behind. Now, a word of caution is warranted. The fact that Shanghai's price is higher does not guarantee that New York will experience a linear price increase. The process of arbitrage is inherently complex and can be protracted. It involves logistical challenges such as shipping delays and capital control measures. Consequently, we may witness days where the New York price experiences a sharp decline. Financial institutions might attempt to manipulate paper prices downwards to $68, triggering stop-loss orders. However, it is crucial to remember the magnet, which is the $75 price point in China. As long as this price remains in effect in China, any reduction in New York's price will simply create a more substantial profit margin for arbitrage traders. If silver drops to $68 in New York and maintains its $75 price in China, the profit differential expands to $7. This wider spread incentivizes increased buying activity in New York. Therefore, the price in Shanghai acts as a stabilizing force, making it exceptionally difficult for financial institutions to suppress prices and maintain them at lower levels. The fundamental physics of the market are operating in your favor. While the price in China is elevated, one might question who is bearing this cost. Are these speculators, government entities, or something more profound? In the subsequent section, we will delve into the industrial stockpiling phenomenon. We will examine the substantial reserves of silver being accumulated within the free trade zones of Shanghai and Shenzhen. We will explain why Chinese solar manufacturers are adopting a strategy of purchasing silver as a precautionary measure rather than relying on just-in-time inventory management. Furthermore, we will assess the potential risk of a supply disruption impacting American companies such as Apple and Tesla. If all available silver is directed towards China, what will be the consequences for American industry? The trade conflict is intensifying, and silver is emerging as a critical component. Please stay tuned for Part 2, where we will gain insight into China's silver reserves. If you are just joining us, let's briefly recap the situation. In the first part of our analysis, we established a crucial piece of information. Silver is trading at $70.47 in New York, while in Shanghai, it is priced at approximately $75. This price discrepancy is effectively transferring wealth from the West to the East. But the question arises, why is China willing to pay a premium? Why are they prepared to pay $5 above the global price for every ounce they can acquire? Is this driven by speculation, or is it indicative of a bubble? The answer is unequivocally survival. China serves as the manufacturing hub for the entire world, and the managers of these factories have recognized a startling reality. Without silver, their operations will cease. Consequently, they have abandoned the pursuit of pure efficiency and have embraced a strategy of acquisition and preservation. In Part 2, we will investigate the extensive industrial stockpiling occurring in China. We will explain the transition from a just-in-time to a just-in-case inventory management approach. Additionally, we will highlight the risks this poses to prominent American corporations like Apple and Tesla. While China actively procures the available supply, American factories are operating with severely limited resources. The metal is being redirected, finding its way into vaults that are largely invisible to us. Let us trace this flow. For the past 3 decades, the global economy has operated under a principle known as just-in-time. The core idea was straightforward. Inventory represents waste. Holding a warehouse full of silver that is not actively being used incurs costs and offers no immediate return. The objective was to have silver arrive at the factory dock precisely 1 hour before it was needed. This methodology fostered efficiency and enhanced profitability for companies. However, the just-in-time system is only effective when supply chains are robust and uninterrupted. When supply chains experience disruptions, the just-in-time approach quickly becomes too late. Chinese manufacturers learned this critical lesson during the global pandemic and again during the semiconductor shortage. They are now applying this hard-won knowledge to the silver market. They are shifting towards a new philosophy: just in case. Instead of purchasing silver for the immediate upcoming week, they are acquiring it for the entire following year. This involves the creation of substantial internal stockpiles. If a solar panel manufacturer requires 1 million ounces of silver per month, they are now maintaining reserves of 6 million ounces. The rationale behind this is their understanding that prices are projected to increase. Acquiring silver at $75 today is significantly more economical than purchasing it at $100 tomorrow. More critically, they harbor a profound fear of stockouts. Should their supply of silver paste be interrupted, the assembly line would halt, workers would be sent home, and customer orders would be cancelled. The financial repercussions of such a production shutdown far outweigh the cost of the silver itself. Therefore, they are willing to pay the premium, the additional $5. They perceive this extra cost not as an expense, but as an insurance premium against the risk of running out of essential materials. This practice generates a demand that is effectively bottomless. As long as factories remain operational, they will continue to purchase silver, irrespective of market signals or technical indicators. Where is this silver ultimately going? Our examination of the Shanghai Gold Exchange's inventory reports indicates a rise in stocks, but not an exponential increase. So, where is the remainder of the supply? It is situated within bonded warehouses. China possesses extensive free trade zones in key locations such as Shanghai, Shenzhen, and Hong Kong. These zones are designated as special economic areas where goods can enter without immediately being subject to Chinese import duties for tax purposes. They effectively exist in a state of temporary suspension. We are observing significant shipments of silver originating from London and Switzerland entering these zones. Once the metal crosses the threshold into these zones, it effectively disappears from public view, becoming dark inventory. It is no longer officially reported on the COMEX or the SGE. This untracked supply sits in waiting either for deployment by solar factories and battery plants or for a future strategic need. This creates a statistical illusion. Western analysts relying solely on publicly available data might conclude that China's silver holdings are not substantial. They are mistaken. Their analysis is limited to the visible storefront, neglecting the vast warehouse facilities behind it. The accumulation within these zones is estimated to be in the hundreds of millions of ounces, forming a black hole that absorbs supply without any corresponding outflow. We have previously discussed the solar industry's demand, but it is imperative to examine this week's figures. It is late December, and China is accelerating its efforts to meet its year-end installation targets. The demand for TOPCon solar panels is experiencing a vertical ascent. Chinese solar manufacturers are currently consuming silver at a rate that surpasses global mine production. To reiterate, a single industry within one nation is utilizing an amount of silver equivalent to the entire planet's annual output from mining operations. This is the fundamental reason behind the $75 price in Shanghai. It is a vigorous bidding war among solar companies where Company A offers $72, Company B raises to $73, and Company C escalates to $75. They are, in essence, outbidding each other to secure the essential materials. This is not speculative behavior. It is driven by industrial necessity. Furthermore, given China's prohibition on the export of silver ore, domestic miners are compelled to sell within the country, yet this supply is insufficient. Consequently, imports become necessary. They are actively drawing silver bars from London and New York, effectively draining global reserves to power their own industrial expansion. Now let us turn our attention to the other side of the Atlantic, to the United States. We also have major technology corporations, including Apple, Tesla, and General Electric, which require significant quantities of silver. However, they are in direct competition with a formidable Chinese entity that is demonstrably willing to offer higher prices. If a refinery in Switzerland possesses 1,000 bars of silver and China proposes $75 while New York offers $70, the bars will inevitably be directed towards China. This scenario places American companies in a precarious supply predicament. They contact their suppliers seeking metal only to be informed that the supply has been allocated to Asia or that delivery is possible, but at a significantly higher premium, now $10. This is how inflation impacts the American economy. It is not solely a consequence of the Federal Reserve's monetary policies. It also stems from the physical assets themselves seeking more favorable prices elsewhere. We are effectively importing inflation because we are exporting our strategically vital resources. While Apple may possess billions of dollars in cash reserves, they are incapable of manufacturing silver. If the silver is held within a bonded warehouse in Shanghai, it cannot be incorporated into an iPhone manufactured in California. This creates a significant strategic vulnerability for American industries. We are reliant on a globalized market that is undergoing a rapid fragmentation into distinct regional blocks. At present, the Asian bloc holds a decisive advantage in terms of metal availability. Therefore, the flow of silver is predominantly eastward. The price differential is widening, but there is an additional dimension to this narrative: currency. Why is silver experiencing a price increase even though the US dollar remains relatively strong? The explanation lies in silver's ability to anticipate a fundamental shift in the global monetary order. The Chinese renminbi is progressively evolving into a currency backed by tangible resources. In contrast, the US dollar is a currency supported by debt. In Part 3, we will examine the emergence of a gold and silver standard in the East. We will analyze the reasons why the price in Shanghai is setting the global benchmark, and it transcends simple arbitrage. It signifies an erosion of confidence in Western pricing mechanisms. We will elucidate why the paper short positions in New York are rendered ineffective against a physical demand in Shanghai, a demand underpinned by a sovereign currency. The trade war is escalating into a currency war, and silver is serving as the ultimate arbiter. Stay tuned for Part 3, where we will explore the decline of the dollar standard. If you have followed us through Parts 1 and 2, you have a firm grasp of the tangible realities. You understand that silver is flowing from New York to Shanghai due to a $5 price discrepancy. You are aware that Chinese industry is proactively stockpiling materials in anticipation of future needs, while American industry is struggling under a just-in-time system. However, this narrative extends beyond mere supply chain dynamics. It is fundamentally a story about money itself. For the past 50 years, the US dollar has held the status of the world's primary reserve currency. This position enabled the United States to issue paper currency and acquire tangible assets. We printed dollars and Saudi Arabia provided oil. We printed dollars and China supplied consumer goods. But what transpires when the global community begins to favor tangible assets over paper currency. What occurs when China declares, "We will retain the silver, thank you"? In this currency war, we will explain why the Shanghai silver price is not merely an industrial indicator, but a definitive monetary declaration. We will analyze the transition from debt-backed assets to resource-backed assets. Furthermore, we will demonstrate why the short positions held by New York's financial institutions are powerless to counteract a price surge financed by the sovereign currency of a global superpower. The trade war has concluded, the currency war has commenced, and silver is the measure of its progress. To comprehend the price established in Shanghai, one must first understand how the East perceives wealth. In the Western world, wealth is often conceptualized as abstract figures: a stock portfolio's value, bond yields, or bank balances. These are essentially financial claims, promises of future payment. In the East, particularly within the BRICS nations, wealth is viewed as tangible resources: oil, wheat, gold, silver, items that possess intrinsic physical value. They recognize that in times of crisis, financial claims can be frozen, subjected to sanctions, or even defaulted upon. However, a bar of silver cannot be digitally compromised or politically sanctioned. Consequently, China is strategically moving towards a resource-backed standard. While they have not yet officially pegged the yuan to gold, they are effectively fortifying their currency by accumulating substantial reserves of strategic commodities. This strategy renders their economy resilient against potential dollar devaluation. When you observe silver trading at $75 in Shanghai, it signifies the market's profound trust in physical assets over dollar-denominated derivatives. It represents a vote of no confidence in the Western financial system. They are willing to incur a higher cost to transition assets from the dollar-based system into the physical realm. For the past century, London has been the arbiter of silver pricing. The London Fix served as the global benchmark, where a select group of bankers convened to determine silver's value, a valuation accepted worldwide. However, today, the London Fix is rapidly losing its relevance. The reason for this is straightforward. London no longer possesses the physical silver to support its pricing. If a price is set at $70, but there is no silver available to fulfill those transactions, the price becomes purely theoretical, a paper price. Shanghai, on the other hand, has the physical metal, the manufacturing capacity, the refining capabilities, and the overwhelming demand. Therefore, the Shanghai Fix is increasingly becoming the de facto real price. Miners in Peru and Mexico are beginning to shift their focus eastward, questioning the rationale of selling based on the London price when Shanghai offers a more advantageous return. We are witnessing a de-Westernization of pricing power, with the global economic center of gravity progressively shifting. Because the East is a net holder of silver and the West is a net short position holder, this power imbalance inherently drives prices higher. The entity that owns an asset will naturally demand a higher price than a borrower who wishes to acquire it. Now let us revisit the position of banks in New York. They are heavily short on silver, and their objective is to drive prices downward. Traditionally, they achieve this by offloading vast quantities of paper contracts, thereby creating an artificial oversupply and forcing prices lower. However, in this evolving dual market reality, this strategy is proving counterproductive. If New York banks were to drive the price down to $65 while Shanghai maintained its $75 price, the spread would widen to $10. What would be the consequence of such a widened gap? It would dramatically accelerate the outflow of silver, rendering American silver so inexpensive relative to Chinese silver that every available ounce would be instantly exported. In effect, the banks would be subsidizing the export of America's strategic wealth. Consequently, the banks find themselves in an untenable position. If they attempt to suppress prices, they risk losing their physical silver holdings. If they permit prices to rise, they incur losses on their derivative investments. They are in a lose-lose situation. This is precisely why we are observing a gradual upward trend in prices. The banks have recognized that they can no longer effectively suppress the market. They are compelled to allow the COMEX price to rise to bridge the gap with Shanghai, a necessary step to avoid defaulting on their obligations. The Shanghai demand acts as an underlying support for the market. Every time New York experiences a dip, Shanghai steps in to purchase. It serves as the ultimate price floor. There is yet another critical element to this currency war: inflation. We commonly associate inflation with the Federal Reserve's expansion of the money supply. However, inflation can also arise from currency debasement. As the BRICS nations increasingly engage in trade using their local currencies, the demand for US dollars diminishes. These repatriated dollars then circulate within the American economy, contributing to domestic inflation. Silver serves as an early warning signal for this process. Its rising price is an indicator that the petrodollar system is beginning to falter and that energy is being repriced not solely in dollar terms, but also in gold and silver equivalents. When you purchase silver at $70, you are essentially hedging against the erosion of the dollar's privilege status. You are making a bet that in the future, goods and services will be valued based on intrinsic worth rather than fiat currency, and silver currently represents one of the most undervalued assets on Earth. So, what is the projected price target? We are currently at $70.47, with Shanghai at $75. The fundamental laws of physics dictate that these two figures must converge. Given that Shanghai possesses the physical weight in the market, New York is compelled to ascend. This positions $70 as a magnetic target for the COMEX. This is not a matter of speculation, it is a process of price equalization. We can anticipate the COMEX price to gradually increase over the coming days to close this price differential. Traders are acutely aware of this dynamic and are actively buying on the COMEX, anticipating the eventual convergence of prices. This buying pressure is persistent and unyielding, disregarding technical resistance levels and overbought indicators. It is simply mathematics resolving itself. Therefore, the arbitrage is a tangible reality, the currency war is escalating, and the price gap is destined to close. How should one navigate this situation? Is it too late to purchase at $70? Should one wait for a price pullback? Or has $70 established itself as the new floor? In Part 4, the concluding segment of this market alert, I will provide a comprehensive investment strategy. I will explain why the practice of dollar cost averaging can be detrimental in a market experiencing a vertical ascent. I will introduce the concept of a ratio trade, detailing how to utilize the gold-silver ratio as a tool for timing market exits. Finally, I will offer my definitive assessment on whether we are witnessing a market bubble or a necessary correction to market realities. The West is currently losing the silver war, but you do not have to suffer a similar fate. You can adopt the trading strategies employed by the East. We are finalizing our strategic plan. We have reached the concluding chapter of this market analysis. We have journeyed from the trading floors of New York to the secure bonded warehouses of Shanghai. We have meticulously exposed the $5 arbitrage gap that is systematically draining Western reserves. We have critically analyzed the phenomenon of industrial stockpiling and the ongoing currency war. The overall picture is now undeniably clear. The silver price of $70.47 is fundamentally misleading. It represents a temporary concession offered by a compromised and dysfunctional paper-based market. The actual cost for those who genuinely acquired the metal has already reached $75 in the East, and the ironclad laws of economics dictate that two prices for the identical asset cannot persist indefinitely. They must converge. Consequently, with the East possessing the metal, the West is compelled to ascend. In this concluding segment, Part 4, I will present an investment blueprint. I will elucidate why the strategy of dollar cost averaging may prove inadequate in a market experiencing rapid vertical ascent. I will demonstrate the ratio trade, a clandestine method employed by the affluent to secure profits without ever reverting to fiat currency, and finally, I will deliver a definitive judgment on whether this situation constitutes a speculative bubble or the establishment of a new economic reality. The disparity is diminishing and the opportunity is narrowing. Let us conclude this analysis. For an extended period, financial advisors have advocated for dollar cost averaging, advising the purchase of small increments monthly to mitigate price fluctuations. While this approach is sound in a declining or stagnant market, it transforms into a pitfall during a vertical price surge. The reason is that you are perpetually pursuing an escalating price. If you purchase 1 ounce at $30, then another at $50, and subsequently one at $70, your average acquisition cost continuously climbs, resulting in diminishing returns for your capital. When a market enters a phase of genuine price discovery, as evidenced by the current Shanghai premium, the investment strategy must adapt. Sophisticated investors do not employ dollar cost averaging. They front-load their acquisitions. They comprehend the fundamental shift occurring and recognize that $70 now represents the new baseline due to arbitrage opportunities. Therefore, they commit their resources before this price disparity is resolved. They capitalize on the breakout and refrain from awaiting a potential retracement that may never materialize. If you're holding on to cash, anticipating a return of silver to $50, you might be waiting for a departure that has already occurred, leaving the tracks destroyed. The Shanghai benchmark indicates that any decline below $70 will be immediately countered by automated arbitrage transactions. Consequently, the prudent course of action for the ambitious investor is not to delay, but to establish a position. Secure your metal, take physical possession, and then adopt a patient stance. The paramount question then becomes, when do I divest? However, divest for what purpose? For dollars? Why would one exchange a vital strategic asset for a currency undergoing devaluation? The wealthy do not liquidate for cash, they engage in exchanges. They trade one undervalued asset for another. The most potent instrument for this is the gold to silver ratio. Currently, with gold priced around $3,000 and silver at approximately $70, the ratio hovers around 43 to 1, meaning 43 ounces of silver are required to acquire 1 ounce of gold. Historically, this ratio tends to revert to its average. In 1980, it reached 17 to 1, and in 2011, it was 30 to 1. Geologically, the ratio of extraction from the earth is 8 to 1. This provides your strategic roadmap. Zone 1, when the ratio exceeds 40, silver is comparatively inexpensive against gold. In this phase, you retain your silver, accumulate more, and weather the price volatility. Zone 2, when the ratio reaches 30, this serves as your initial indicator. You might consider exchanging a portion of your silver for gold, trading the more volatile industrial metal for the more stable monetary metal, thereby preserving your purchasing power. Zone 3. When the ratio drops to 15, this is the definitive signal for a complete pivot. History suggests this level is seldom sustained. At a 15 to 1 ratio, you would exchange all your silver for gold, effectively tripling your gold holdings without additional capital outlay, simply by leveraging the ratio. You would never touch a dollar, nor incur capital gains tax. You would merely transition between precious metals. This is the method by which enduring wealth is cultivated, not by chasing nominal gains in fiat currency, but by accumulating physical ounces. Is $70 a speculative bubble? The media will assert it is, proclaiming a frenzy. However, let us revisit the inflation-adjusted financial data one last time. In 1980, silver reached $50. When adjusted for inflation, that $50 equates to approximately $170 today. Therefore, at $70, we are not approaching the all-time real high. We are less than halfway there. Now consider the underlying economic drivers. In 1980, we did not have solar panels consuming 20% of the global silver supply, nor did we have 5 billion smartphones, nor 48-volt electric vehicles, nor a Chinese export embargo. The fundamental factors supporting silver today are 10 times more robust than in 1980, yet the price remains lower. This indicates that this is not a speculative bubble, but rather a recalibration of value. The market is finally recognizing that a strategic energy metal cannot be valued as a mere collectible. It must be priced akin to oil or lithium, and given that silver is rarer than both, its price must ascend to regulate demand. $70 is not the pinnacle. It is the point of departure. Let us summarize the week's analysis. Fact 1. The New York market is trading at $70.47. Fact 2. Shanghai is trading at $75. Fact 3. This arbitrage disparity necessitates the movement of physical metal eastward, depleting Western reserves. Fact 4. The sole method to halt this outflow is for the New York price to reach $75. The path of least resistance is upward. Financial institutions are in a precarious position. If they attempt to suppress the price, they risk losing the physical metal. If they permit it to rise, they forfeit their derivative positions. They have relinquished control. The captain of the Shanghai market is now at the helm, and their course is set for higher valuations. Therefore, here is your strategy. Disregard market fluctuations and the pronouncements of news anchors who lack an understanding of arbitrage. Monitor the price differential. As long as Shanghai's price surpasses New York's, maintain your holdings, as the demand vacuum will draw prices upward. Endure the downturns and consolidations. Do not permit yourselves to be prematurely shaken out in the nascent stages of a bull market. The East is acquiring, industry is acquiring. You should be holding. This concludes our examination of the Shanghai arbitrage situation. The price gap is a tangible reality, and the opportunity it presents is significant. Now observe its resolution.